actually think the Australian market's pretty good value at the moment, especially for long-term investors. So whatever valuation metric you look at, whether it's price-earnings ratio, price to book, risk premium or dividend yield, the Australian market looks great long-term value. Now, the debt issues that we do have around the world, they are very likely to lead to a lower growth world. I think we are in this lower growth world for a prolonged period. But when you come back and you look at the Australian market, we have an Australian market that's delivering a dividend yield of 5.5% plus growth, although it's not high growth. That's actually going to deliver some pretty good returns. I think this structural cyclical debate is a really important one. So obviously all the time we're looking for structural growth because I think in a low growth world, if you can deliver structural growth, you're going to be bid up by the market. On the other side of it though, you want to stay away from structural decline. Cyclical decline we're sort of okay with. So if you look at a business and you think, okay, through the cycle, this business should earn 15% return on equity, but it's a bit cyclically depressed. That's actually a much easier business to try to value. Structural decline though is much more difficult to value. So whether structural decline finishes here, here or here is very, very difficult to predict. And there's huge valuation differences depending upon where that structural decline ends. The internet is probably the most disruptive. So whether I look at the internet's impact on retail or on media, it's having a very significant impact. It's putting a lot of pressure on traditional bricks and mortar retailers and traditional media as well. And actually trying to work out how far that structural decline happened is very, very difficult. China is slowing, commodity use is slowing, the super cycle is slowing, but I don't think it's dead. Iron ore prices have come from $200 down to $100. That's a long way down, but $100 is still a fantastic price for iron ore. And I think in this environment, what you need to do, rather than focus on commodity price movements, is really play the cost curve. So the cost curve for iron ore ranges anywhere from $30 a tonne to $140 a tonne. Those players that are between 100 and 140, they're going to go out of business. But if you're pulling iron ore out of the ground at $30 a tonne, like BHP is, like Rio is in the Pilbara, you're in a fantastic position to expand production. Sydney Airport, I think, is actually a great long-term investment, especially in this sort of market. So we are in a low-growth world, and I think in a low-growth world, what investors are looking for is sustainable yield. So if you can deliver sustainable yield in a low-growth world, you're going to be bid up by the market. Also, if you can deliver structural growth in a low-growth world, you're going to be bid up by the market. Sydney Airport has both. It's got a great dividend yield, it's already paid a big capital return, and it's a structurally growing market. Passenger growth is mid-single digits, and they're actually getting additional yield coming through from that passenger growth as well. So dividend yield, capital returns, structural growth in a low growth world, that's a great investment.